Silver crashed 20% this week and Wall Street bought the dip, allegedly. So what does this mean for us? Look, I'm not going to tease you with the answers. I'm going to tell you straight up and then you can decide if you want to spend another 5 minutes watching this video. So first, Wall Street engineered this paper crash to trigger a massive wall of retail stop losses. Second, while retail investors are panic selling, institutional players just quietly scooped up 33.8 million tons of physical silver through the SLV ETF. And third, this is a classic wealth transfer designed to use you as exit liquidity, allegedly. Anyway, my name is Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor and this is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. All right, I'll slow down now. Let's figure this out together. Right now, the media is saying that the great silver run of 2026 is completely over. They point to sticky inflation, keeping rates higher, keeping the US dollar stronger, and making non-yielding assets a terrible investment. Same old crap every time. They want you to believe that the macroeconomic environment has fundamentally shifted. They tell you that silver failing to hold support means that you need to dump your positions immediately. Look, the cynical observer would argue that this is complete nonsense. Over the short term, sure, the paper price is dropping violently, but structurally, look, the media always forgets to mention how the futures market works, right? How paper silver works. And that's to their benefit because it's complex and confusing and most investors ignore it. And they think that the price of paper silver actually means something in reality. Heading into this month, silver was a heavily crowded trade filled with inexperienced retail investors using massive amounts of leverage. A lot of these people have left crypto because crypto started sucking and they piled into silver, right? And Wall Street loves it when retail uses leverage because it sets up a perfect trap for them. So let's talk about this trap. I'm going to explain how it works. So retail traders, they always place their stop losses just above or below support resistance area. So you got a support area, for example, they place their stop loss here because they think that this support area is going to protect them. But it doesn't, because institutional algorithms can predict and in some cases actually see where those orders are clustered. So massive banks dump thousands of paper silver contracts on COMEX or other markets in seconds. This artificial selling pressure knocks the price down just enough to hit those retail stop losses, which then automatically trigger as market sell orders, creating a devastating self-fulfilling spiral of false liquidations because those stop losses cause more sales, cause more sales, cause more sales, so on and so forth. Now, a lot of people take this personally. They think that the institutions are out to get them specifically. They're like, oh, I got stop hunted by a exchange or whatever. But institutions don't care about your tiny trade. And I don't say that in a demeaning way. It's just tiny to them because they trade billions of dollars. So pretty much any retail trader is tiny. They care about clusters of orders, a lot of tiny orders that build into a lot together to fuel their major trades and to get them into positions cheaply. Because that's what they need. They flush out the paper market to create a cascade of sells so they can buy cheaper. But what are they buying? Well, right now they are buying actual physical metal at a massive discount while retail is left holding a bag of paper trash or at least getting stopped out and holding cash, right? And losing some cash in the process. So it's a wealth extraction machine, allegedly. But you won't hear about this engineered washout on the mainstream financial networks. The public message they broadcast and what smart money is actually doing, smart money, by the way, I don't actually think they're smart, evil money, let's call it, are two completely different things, right? And I know that sounds like a conspiracy theory, but look, over the last 10 years alone, JP Morgan, UBS, Barclays, HSBC, Chase Bank, Deutsche Bank, and more over the last 10 years alone have been fined for precious metal market manipulation. So it's not conspiracy, it's just business. And you know how these fines work, by the way. They make like 10 billion, they get fined 1 billion, and they walk away with 9 billion in profit, and they just keep doing it, right? So let's talk about what's been happening as silver has been dumping recently. While retail was panic selling their silver, trading volumes on the SLV ETF absolutely exploded. We saw 94 million shares traded, which is roughly 2.5 times its normal volume just yesterday. And in the middle of this chaos, institutional players quietly added 33.8 million tons of silver to the trust. They are publicly telling you that the rally is dead while privately hoarding the physical assets for themselves. If you want proof that this disconnect is real, just look at COMEX registered vaults right now. I went into depth on this in my last video on my main channel. It should be popping up on your screen pretty soon. Just keep watching. Look, because the truth is, this crash isn't a verdict on silver's fundamental value. The cynical observer would say it is a violent mechanical reset designed to transfer wealth from the impatient retail traders to the patient institutional vaults. So what does this mean for us? Well, for me, I'm not giving up my physical silver. I'm a long-term holder. These price swings don't bother me. Watch the video that's up on your screen right now. See you in the next one.